Most dividend investors are going to retire broke. Not because they picked bad stocks, but because nobody told them the math doesn't work. My name is Tony, and today I'm going to show you exactly why the most popular dividend strategy out there is designed to make you wait decades before you see real money, and what you should be doing instead if you actually want to live off dividends while you're still young enough to enjoy it. So make sure to stay until the end to understand it. Leave a like, and let's start with the uncomfortable truth. Dividend growth investing is sold to you as this dream. You buy solid, stable companies. They pay you dividends every quarter, and slowly but surely, you build up enough passive income to cover your bills. Sounds perfect, right? Here's the problem. The most recommended dividend stocks out there, the ones you'll find in every beginner's guide to dividends video, have yields between 2% and 3%. That's it. Johnson & Johnson sits at around 2.5%. Procter & Gamble around 2.5%. McDonald's around 2.2%. These are the stocks everyone talks about. So let's do the math together. Say you have $10,000 to invest. You put it all into Johnson & Johnson. At roughly $166 per share, you can buy about 60 shares. With a dividend yield of 2.5%, you're earning about $250 per year. That's $20 a month. $20 after investing $10,000. Now J&J does raise their dividend every year. That's actually why people love it so much. They've raised it for 58 years straight. But the rate at which they raise it, it's around 6% per year. And if you run that through a dividend calculator over 40 years, even reinvesting every single dollar you receive and never spending a cent of it, you end up with around $64,000 total in dividends after 4 decades. 4 decades. 40 years of your life waiting for $64,000 in dividends. That's not financial freedom. That's just patience with a really bad payoff. Now here's what nobody says out loud. Dividend growth investing only makes sense if you're already rich or if you're extremely young and willing to sacrifice basically everything for 30 or 40 years. If you have $1 million to invest, sure, 2.5% gives you $25,000 a year. That's something. But if you're working with $10,000, $50,000, even $100,000, you're looking at numbers that won't even cover a car payment. And yes, the classic advice is to just keep buying more shares. Keep reinvesting. Be patient. But the reality is that most people who start this journey end up quitting because the progress feels invisible. You check your account after a full year of investing and you made $240 in dividends. That doesn't motivate anyone. So what's the solution? You need to change what you're investing in. If you want to live off dividends sooner rather than later, you need to target investments with higher yields, not recklessly high. We're not talking about chasing random 20% yields from companies that are falling apart, but strategically higher from investments that are built specifically to generate income. The first category that stands out are called covered call ETFs. These are a newer type of investment that most people still don't know about, but they're absolutely worth paying attention to. The way they work is actually pretty simple. The fund buys a basket of stocks, for example, stocks that track the NASDAQ 100, and then it sells something called call options on those stocks every single month. The money collected from selling those options gets passed directly to investors as dividends. The result? Dividend yields that are dramatically higher than anything Johnson & Johnson will ever offer you. A well-known example is the ticker QYLD, which currently sits at a dividend yield of around 11.5%, and it pays every single month, not quarterly. Let's go back to that same $10,000 example. If you put $10,000 into QYLD at its current share price of around $22.56, you'd own roughly 443 shares. An 11.5% yield, you'd be earning approximately $100 per month. That's 5 times what J&J gives you. on the same $10,000. And here's where it gets interesting. If you reinvest that $100 every month into more shares, the snowball builds at a much faster rate. You're adding more shares each month, those shares produce more dividends, and so on. The compounding happens faster because you're starting with a much higher yield. Now, covered call ETFs do come with a trade-off. Because the fund is selling call options, there's a ceiling on how much the share price can grow. You're essentially trading some upside growth for that high monthly income. So if your goal is purely price appreciation, this isn't the right tool. But if your goal is income, actual cash hitting your account every month, these are hard to beat. Another option worth looking at is NUSI. This one uses a slightly different approach. It buys call options and also sells put options, which means it has a bit of a protective buffer on days when the market drops. The trade-off is a lower yield, around 7.9%, but the share price tends to be more stable. It's a good middle ground for people who want solid income without as much volatility. If you're listening there, comment with the name of your pet. I'll like everyone who does it. The second type of investment I want you to know about are called BDCs, Business Development Companies. These have been around since 1980, and they work like this. A BDC lends money to small and medium-sized businesses that can't easily get loans from a regular bank. In return, those businesses pay interest back to the BDC. And here's the part that makes BDCs so attractive for dividend investors. By law, BDCs are required to pay out at least 90% of their income to shareholders as dividends. That legal requirement is why BDC dividend yields are consistently high. It's not a coincidence or a short-term promotion. It's built into how they're structured. One of the biggest and most well-known BDCs is Ares Capital, ticker symbol ARCC. It currently yields around 8.2%, and it has a long track record of maintaining and growing its dividend. Another solid option is Newtek Business Services, ticker NEWT, which has also shown meaningful dividend growth over the years. Most BDCs pay dividends quarterly rather than monthly, but at yields like these, even quarterly payments add up fast. So here's the takeaway. There's nothing wrong with Johnson & Johnson as a company. But if you're buying it because you want to live off dividends, you need to understand what you're signing up for. Decades of waiting for a yield that starts at 2.5%. If that timeline doesn't work for your life, there are better tools. Covered call ETFs like QY, LD, and NUS. I can give you yields 5 times higher than most traditional dividend stocks, paid monthly. Business development companies like ARCC can give you yields above 8% with a legal obligation to keep paying them. The strategy is simple. Target higher yield investments, reinvest your dividends as often as you can, and watch your income stack up far faster than the traditional approach. On some months, you might want to spend those dividends, a trip somewhere, a big purchase, and that's fine. Then reinvest the next month. The key is that you're building something you can actually feel, not waiting 40 years to see a result. The math is on your side when you use the right tools. Subscribe for more videos like this one, and watch the video that will appear on your screen soon. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depends on your own decisions and actions.